My name is Alex Kindler. I'm partner in charge of business valuation and litigation support here at H2R CPA. Today we're going to talk about some of the ways that business owners may try to hide or disguise assets and possibly income in a divorce setting, equitable distribution, disposable income. Now, one of the most obvious ways that business owners may try to hide assets or income would just simply be to skim some cash. Now, if that cash is $20 a week out of the cash drawer, it's got to be kind of tough to find, and also in the grand scheme of things, probably not that relevant. But when we're talking about possibly thousands of dollars, then it's a different story. Now, not all businesses have the ability to skim cash. Obviously, if it's a business that typically receives credit cards and checks, there's not a lot of cash involved. But businesses such as restaurants, bars, laundromats, hair salons, pizza shops, they're all possibly subject to have some skimming, which may involve some forensic accounting work to see if all the income is in fact declared. In fact, one of the ways that we sometimes look at these cash businesses are use some of the guides that the IRS uses when they're conducting audits. For instance, if it was a laundromat, there are actually guides that tell you, based on the water usage of various washing machines, if they've used so many gallons, you can convert those gallons into cash to see does that in fact match the receipts that are being reported. So there are a lot of techniques, some more sophisticated than others, as to how you can possibly disclose and discover some of the cash. There are some businesses where in fact they actually keep two sets of books. One that they provide to their accountant to prepare the tax return, and another that are used for internal purposes for management, for management decision making. And sometimes the spouse is aware of the second set of books, so it's something to inquire about. Also, if we're looking at the income that the business is generating for a business owner, you need to take a look at the balance sheet just to see, is it possible that the business is actually retaining cash that it doesn't need for current operations, and that income could be distributed to the business owner. So undistributed cash is obviously another area that we need to take a look at. Now, there are other ways that a business owner, an unscrupulous business owner, may try to show that the income or the value of the business is worth less by possibly inflating certain expenses. A business owner could potentially write checks to non-existent employees, and then after the divorce is over, just void the checks. Same thing with checks written to family members or friends, boyfriend, girlfriend, for services that really are never performed. Which is one of the reasons why we always ask for copies of W-2s, 1099s, to see who are these people that are getting paid and what services did they provide for those payments. Then we have those assets that may be considered more personal in nature, that the business may own, automobiles, boats, airplanes, fine art, oriental rugs, condominiums. It could be any number of things which, even if there may be a slight business purpose, they may not be totally necessary. And it's important to take a look at the depreciation schedule to understand what the assets are. I had a situation a number of years ago where I looked at the depreciation schedule for a business and saw that they had 3 condominiums listed on the depreciation schedule And this was a business that only operated out of one location. Turned out the 3 condominiums were all located in fancy ski resorts. And when I reviewed the W-2s, it turned out that there were 3 employees who in fact had the address of the condominiums in those places. So it turned out that they were the owner's girlfriends who lived in each of those condominiums. Obviously, we were talking about a divorce situation. So it's important to look at the details behind the records, both on the employee side and on the assets of the business. The other thing that a business owner could do, possibly would be to defer the acceptance of a contract. So it's important to see what contracts are outstanding, because they may be trying to defer some income related to those contracts. They could also accelerate expenses. They could prepay rent, prepay insurance, a number of things they may do to try to drive the cash in the business down, inflate the expenses to, again, make the overall profitability of the business look lower. They could make purchases for fixed assets that maybe it wasn't necessary to replace those assets at this point. Again, just trying to do things to increase expenses to lower business value. They could decide to bump the profit sharing expense. They may make advanced deposits on certain items. So these are all details that we need to take a look at. Of course, the other thing we need to look at is the nature of the expenses that the owner is having. What personal expenses might, or perks might the business be paying for the owner? Is the business paying the medical insurance, the life insurance? What about home utility bills, personal travel and entertainment, country club dues, health club dues, personal auto expenses, charitable donations, telephone and cell phone usage. We've seen repairs and landscaping on a personal residence run through a business. We've even come across salaries paid for household employees and nannies. So all of these things are items that need to be looked at to make sure that we're getting a true picture of what a business is worth and what that cash flow of the business might look like. So, in general, I don't believe you should really hire a forensic accountant unless there are 4 conditions that are met. The first being that you actually have a reasonable suspicion that there may be income or assets that are being hidden. Second being that the spouse, the business owner, has significant control over the management of the business. Third, that a business valuation is probably going to be required, and this is something that your legal team would advise you that they believe a valuation would be necessary. And finally, we of course want the benefit to outweigh the cost. I wouldn't want a client to spend $10,000 for forensic accounting fees to discover $5,000 in missing assets. On the other hand, if a client could spend $5,000 in fees to recover $50,000 of assets, well then clearly that would be a worthwhile endeavor. We've covered a lot of ground in this video. If you have any questions about anything that I've discussed, please feel free to contact me. And also, if you are in need of a family law attorney, we have the names of many qualified professionals in the area. Please feel free to contact us, and we'll give you the name of one of those professionals. Thank you.